Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures lower to kick off the final trading day of the third quarter. And it has been a strong quarter for stocks and one of the best Septembers in recent years. The S&P 500 on track for its best September since 2010, with the index rising 3% in what is historically a down month for equities. But going into the fourth quarter, investors are eyeing some risks, among them a government shutdown. Vice President J.D. Vance says he believes the government will shut down. That's after Trump met with top congressional leaders. A shutdown would delay the release of key economic indicators, including the monthly jobs report this week, and at least temporarily furlough hundreds of thousands of federal workers. This would be the first shutdown since 2018, when government funding lapsed for 5 weeks. And tariffs are also back in focus. President Trump ordering 10% duties on imports of softwood, timber, and lumber, as well as 25% levies on some wood furniture products. The tariffs are set to go into effect on October 14th, according to a proclamation signed Monday. Trump said the planned actions will strengthen supply chains, bolster industrial resilience, create high-quality jobs, and increase domestic capacity utilization for wood products. Let's get a check in on stock futures. With that shutdown imminent, we see stock futures backing off a little bit, but not moving much really across the board. We've got 0.1% or so declines indicated for the major averages. The NASDAQ, very little change to the downside. Let's dig now into our top stories of the day. The clock is ticking toward a government shutdown with just hours left for Congress to pass a funding bill. And stocks are falling on the last trading day of the third quarter ahead of that shutdown deadline. Plus, President Trump ordering new tariffs on timber, lumber, and wood products. Joining me now, senior reporter Ali Canal live at the NASDAQ, Washington correspondent Ben Werschel, and also with us Kevin Munn, Hennian and Walsh CIO. Ben, I want to start with you on the latest on the shutdown. There was that meeting that was much awaited yesterday between President Trump and top congressional negotiators from both sides, and they came out with not much.
Exactly. They seem to be about exactly nowhere on this shutdown. We are, as we sit now, we're about 15 hours from a potential shutdown. The commentary following the meeting, including through this morning, including through the last hour, has been essentially both sides digging in. So there's the odds are clearly spiking here for a shutdown. The one place to watch today is the Senate. We're expecting 2 votes there on a Democratic and a GOP plan there, but the widespread expectation there is for essentially a rerun of identical votes that happened a week ago that saw both of those measures fail to advance. So it's also clearly not helping that Trump's response here, his main response has been to post a profane video of deepfake video of Chuck Schumer that we can't even play on the air here. So both sides are moving farther apart, and shutdown odds are in the kind of 90%. Two dynamics I did want to flag. The ways that maybe ways out of this, maybe not today, but could be sort of more for the more economically important question of whether this is an extended shutdown. The first is whether there is areas of compromise on healthcare. The Democrats have made 2 demands here. One is a clear non-starter, essentially rolling back some areas of the big, beautiful bill that Republicans spent so much time getting passed earlier this year. The other is expiring Obamacare subsidies. There is a little bit of bipartisan support for this, and this is pressing for lawmakers, as this would be a price hike for consumers at the beginning of next year if no action is taken. So there was some commentary last night and this morning that there may be areas there. How long that takes remains to be seen. The other dynamic I think clearly is on the minds here in Washington is essentially Democratic kind of cave watch, for lack of a better term. For a reminder that in March, the way this ended was that moderate Democratic senators and Chuck Schumer banded together to essentially punt on a shutdown. There was a few hours yesterday where it seemed like something similar might be in the offing there. So there's a few ways out of this, but the question essentially, I think, for me is how long this shutdown will be going forward.
Yeah, and you see there a picture of President Trump. That's a live picture of President Trump speaking to reporters. But he, right now, I believe he's talking more about the deal he has proposed for Israel and the Palestinians rather than the shutdown. So we'll keep monitoring that. But Kevin, I want to get to you for a little perspective here on the markets and shutdowns. Usually it's not necessarily a market-moving event. What do you think is going to happen this time?
Yeah, as I understand it, federal government shutdowns, or at least the threat of a federal government shutdown, has become part of the sausage-making process in Washington, D.C. As I understand it, over the last 5 decades, there have been 21 shutdowns of the federal government. Average duration, around 8 days. The maximum one, 35 days. Interestingly enough, that was during the previous Trump administration. The reason I bring that up, because if this goes to that type of duration again, 35 days brings us out to the next FOMC meeting. We certainly don't want the Federal Reserve flying blind with respect to jobs data or inflation data going into that meeting. Perhaps we get that rate cut regardless. But I don't think this is going to have a material impact on the markets or the economy unless it starts to creep more and more out into the future. That's not my base case right now. I think it gets resolved over the relative short order.
Kevin, is it something that would cause you to adjust your strategy at all if it does last longer?
It would certainly make me think about that next Fed rate cut. I think the Fed is going to cut 2 more times this year, both in October and December. Why do I think that? Because that's what the Federal Reserve told us based upon their last dot plot chart. If in fact they don't have the data, if in fact they're uncomfortable with inflation staying benign because they don't get updates on the reports, I believe they're more concerned with the job side of their mandate right now than they are with price stability. So they need the data to be able to process that. If they pause in October, then I'm going to start to think about, well, do they need to play catch up or what's going to happen next?
Right. And of course, feeding into all of that is what's going on with inflation and what's going on with tariffs. Ben, we got some new headlines. Lest we get comfortable with what the tariff levels are and on what, we got some more new ones.
For sure. Trump has been on a bit of a tariffs promising spree in recent days, specifically around sector tariffs. This is kind of a more of a focus for him recently as these blanket tariffs are under more legal scrutiny. The first one deadline is tomorrow, is the same day as a potential government shutdown, October 1st. This would see 100% tariffs on certain branded pharmaceutical products. We don't know a lot of details about how those will be implemented, but one we do know is that the effects could be limited in that companies that are building what exactly building means in the United States would be exempt for those. So there is new pharmaceutical tariffs that Trump has promised tomorrow, as well as new tariffs on semi-trucks that could come into place. October 14th, we have another round of tariffs on furniture and wood products things, 25% on certain upholstered wood products and 10% on softwood timber and lumber. Excuse me. Those would go up on January 1st as well. So a bunch of these waves, but an overall direction towards sectoral tariffs from Trump at the moment.
And Kevin, tariffs, obviously we have seen them not flow through into the economy in a broad way as would have been expected. We are seeing pockets. So do we just kind of ignore them from an investing perspective at this point? I
don't think you can entirely ignore them. It does depend on what the tariffs are placed upon. Are they geographical? Are they country or continent-based? Or are they more good-specific, as we're learning of late? To me, though, tariffs present more of a growth scare than they do an inflation scare, as I still believe the U.S. consumer and the U.S. corporations can pivot and choose to spend or not spend their money as a result of tariffs that are placed upon certain goods within the economy. If, in fact, they choose not to spend as much and keep that money in their pockets or on their balance sheet, that could slow down the pace of economic growth. But we've yet to see that really trickle through meaningfully into the economy in terms of inflationary pressures, but time will tell. We'll see what comes next.
And then, Allie, we got to talk about the timing of today. Well, all of this stuff is swirling around. It's not just a shutdown deadline. We're also coming up on the end of the third quarter. So what do we know about how performance was and what kind of stands out?
Really solid third quarter, and September is certainly bucking that typical seasonality trends that we tend to see a weaker month in September. That just wasn't the case this time around. And if you take a look on a sector basis, that will tell the story a lot better than I can, because quarter to date, the only sector in the green, consumer staples. These are the companies that make your everyday essentials like toothpaste, paper towels. They're the only sector in the red, down more than 3%. The broader market is up over 7%, and you're seeing seeing those gains led by consumer discretionary and tech, both up nearly 11%. So clearly investors aren't fearing a slowdown. They're risk on, they're chasing that growth. And some of these big staple names like Coca-Cola, Costco, even Colgate, they're all down this quarter, reversing some of those gains that we saw earlier this year when tariff worries had investors hiding out in some of those more defensive plays. But now it's all about AI. NVIDIA is up double digits. Intel is up nearly 60%. Even Oracle is rallying on that OpenAI buzz. And to that point, DataTrek had some great context heading into the fourth quarter, with big tech now making up nearly 39% of the entire index. That's up 2 percentage points since the start of the year. And it's also, fun fact, the size of two entire sectors combined. That would be real estate and materials. So it just shows how dominant this group has become. Now, that being said, as you can see on your screen, big tech does trade at a premium, but investors seem willing to pay that, with earnings expected to grow over 19% next year. That's about 40% faster than the rest of the index. So just a few trends heading into the fourth quarter where clearly AI, tech, it's still going to be the big story, Julie.
Yes, it's not going anywhere, that's for sure. Allie, thanks so much. Ben, thank you. Kevin, we're going to talk with you a little bit about your fourth quarter outlook coming up in a moment. Indeed, coming up on Morning Brief, we'll bring you today's top trending tickers, CoreWeave inking a $14 billion deal with Meta, and we'll get Kevin's outlook. That's ahead. Now time for some of today's trending tickers. We are watching Spotify, Exxon, and CoreWeave. First up, Spotify. Those shares are slumping after the company announced that CEO Daniel Ek plans to step down from his role. He'll become chairman. The Spotify co-founder has been at the helm of the company for almost 2 decades. He's leaving leadership in the hands of 2 executives. The company's chief business officer, alongside the chief product and technology officer, will take over as co-CEOs of the music streaming giant. Those 2 execs have been co-presidents since 2023. They've largely been leading strategic and operational development. Next up, Exxon, the oil giant, planning to cut 2,000 jobs, according to Bloomberg. Those reductions represent about 3 to 4% of Exxon's global workforce, and they're part of the company's ongoing efficiency drive. The Texas-based oil company is consolidating smaller offices into regional hubs as part of its long-term restructuring plan. Those layoffs come amidst the backdrop of headcount cuts by other oil majors, including Chevron and ConocoPhillips, who slashed thousands of jobs as oil prices fell this year with OPEC increasing supply. And finally, CoreWeave, those shares jumping after the company signed a deal to supply Meta with as much as $14.2 billion worth of computing power. That deal with Meta helps further diversify CoreWeave's business away from Microsoft, which has historically been its largest customer. Meanwhile, Meta has emerged as one of the top spenders on AI infrastructure. CoreWeave among an emerging group of neoclouds, businesses that rent out access to leading AI chips. CoreWeave stock has more than tripled in value since its March IPO. It's up another 10% this morning. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, as we head into the final trading day of the third quarter, some of the top performing stocks include new entrants to the S&P 500 like AppLovin, media stocks Warner Brothers Discovery and Paramount Skydance, and tech plays like Western Digital, Seagate, and Intel, names that go far beyond the Magnificent Seven. Still with me for a deeper look at how stocks performed in the third quarter and what investors should now do. Kevin Mon, Hennian & Walsh CIO, is still with us. So, Kevin, we did see sort of some broadening in the third quarter, but most of the gains, I mean, and yes, on a percentage basis, you can look at the AppLovins of the world, but because of their size, it's still the likes of NVIDIA that are pulling things higher. Is that still the way to go?
And who would have thought we've been at this point, right? Year to date, the stock market's up over 14%. Remember, through the first 73 trading days of the year, the market was down 10.2%. But I have 2 reasons to still be optimistic over the balance of the year. One of them, believe it or not, relates to the Federal Reserve. According to data from Goldman Sachs, over the last 40 years, the Federal Reserve, when they have cut interest rates by 25 basis points following a pause of 6 months or more, as we just had, in half of those 8 instances, the economy moved into recession. That's not our base case. In the other half of those cases, when the economy continued to grow, even if it was at a smaller pace or a slower pace, the stock market grew by 8% over the next 6 months and 15% over the next 12 months. That's what I believe is going to be the case this time around.
Okay, so reason number 1 to be optimistic, the Fed cuts, and there is no recession.
Correct.
Okay, thing two.
Thing two, AI infrastructure spending. We continue to see billions upon billions of dollars of announcements in AI infrastructure investments. NVIDIA, their CEO Jensen Huang forecasted by the end of this decade, we could see 3 to 4 trillion with a T in AI infrastructure investments. As I understand it right now, we're around 600 billion. So if that is the case, where can we find pockets of growth opportunities, at least for the balance of 2025? Look to the AI infrastructure spending. That's where all the money is heading, and that's where you'll likely find the returns as well.
What about the concerns that sort of arose in the last few weeks, or reignited, because they're not new, about where that money is coming from to spend, right?
Yes.
Is it being borrowed in some cases? Is it NVIDIA investing in a company and then that company spending the money on NVIDIA, as we have seen some concerns about that? And then the other side of that is, okay, there's all of this push to spend.
Yeah.
Where's the return on all of that investment?
So it's a great question. And I continue to use the example that we're in batting practice of a doubleheader as it relates to the AI revolution. Batting practice is the AI infrastructure build out. The games will ultimately involve the implementation of these AI algorithms that will transform the economy and society and likely lead to returns on investment. But that's years down the road. So where are the opportunities right now? Look in the industrial sector. I know it doesn't make sense that you'd look for an AI play in the industrial sector, one of the top 3 performing sectors year to date, but you look for companies such as IES Holdings. They do the electrical connectivity for data centers. Or a company like Comfort Systems, who supplies the cooling solutions to data centers. Or EMCOR, which was just recently added to the S&P 500. They do the site design and construction of the data centers. All part of the AI revolution, but not in the technology sector. And they're receiving returns on their investment right now because they're flush with money that's coming in from large cap tech to build out these capabilities.
Okay, so you've given us 2 reasons to be optimistic,
Yes.
a bunch of investment ideas. What about the other side of all of this? What are you worried about?
I guess I'm most worried at this point in time about the uncertainties. The uncertainties ultimately about what the new tariff and trade framework will look like. Uncertainties over what the Federal Reserve will or won't do next. I remain concerned if this shutdown does last longer than all of us anticipate right now, and it limits the Fed's ability to be more transparent and have some clarity around jobs data and inflation data, and they pause in October. I still believe they should have cut for the first time back in June, but they didn't call me, they didn't ask for my opinion. So if they
You're not on that list
no,
of
I'm not on that list for some
federal,
reason.
yeah.
Jay, give me a call. But if they pause again in October because they don't have data, is that going to then seep into the economy? According to the Atlanta GDP right now, we're looking at about 3.9%. For Q3, with 3.4% coming from the consumer. So that seems good, that seems vital, that seems healthy right now. But if that's all the Fed has and they don't have anything else, they're going to say, well, maybe we need to pause here.
Right.
And I think that could really derail us.
And you're not worried about the job market, it sounds like, or the job market weakening and that feeding over into spending.
I am, and I think the Fed is more concerned about that as well. I think they're more attentive now to the job side of their mandate than they are to the price stability or inflation side of their mandate. I also don't believe they were factoring into their calculus 911,000 fewer jobs being created over the last 12 months. That's why we saw that 25 basis point cut, and that's why I believe we're likely to see 2 more rate cuts, according to their own dot plot chart, over the balance of this year, provided that they have jobs data to look at.
Yeah, and if the shutdown goes on and some of those furloughs turn into firings, then that number could go up more. The other thing I would ask you about is, even as you are positive and optimistic, are you still recommending clients or holding in portfolios gold, things like gold? Are you sort of hedging at all?
I wouldn't look at gold as an inflation hedge, because if you take out the decade of the 1970s, it's actually one of the poorer performing asset classes as it relates to hedging against inflation. But I am recommending them to diversify even further. Look to international markets right now. They're actually outperforming U.S. markets year to date.
Right.
And surprisingly enough, emerging markets are outperforming developed markets. Consider adding some value or some dividend plays into your portfolio. We've gone too long now without any realistic or significant short-term bouts of volatility. We shouldn't expect that to last for that much longer. But I do believe with each short-term bout of volatility, that will be greeted by cash coming off the sidelines, because investors will look at that as an attractive entry point. So expect more volatility, but also anticipate those periods of volatility being short-lasting and create even more opportunities for investors.
Kevin, great to see you. Thanks
You
for
as
coming
well,
in.
Jill. Thank you.
Appreciate it. That does it for Morning Brief. We got much more ahead on Yahoo Finance, including opening bid next. Stay tuned.